This is The Chris Berry Show. Expert information on elder law, retirement, and estate planning. Information that you can understand. Here's your host, Chris Berry.
Welcome to The Chris Berry Show. And each week we start with a positive focus, something positive that happened in the previous week. And it's something that we do with our family as we sit around for dinner every night, sharing a positive focus, something positive that happened during the day. And I like doing that on the radio show as well. I think it sets a good precedent for the show, starting off on a good foot. And so this week, my positive focus is that my son, he's in Cub Scouts. This is, I think, his second year in Cub Scouts. But we had some carvers come in. So some seniors from the local senior center, they have a whittling or carving club where they carve wood. And my son, he just got his first pocket knife through Cub Scouts, and he learned how to use his pocket knife last month as part of Cub Scouts. And this week, he started to learn how to carve. And so these individuals came in and taught the Cub Scouts how to carve with bars of soap. And it was pretty impressive what my son was able to put together. He carved out from a little bar of soap, he carved out a bear that had eyes, and you could tell that there was fur and everything. It was pretty good. I was impressed. All I could manage was carving out a heart, much less impressive than my son. But I was impressed with his focus, and he was pretty proud of his efforts as well. So that was my positive focus. So what we're going to talk about this week on the Chris Berry Show is we're going to talk about money. And we're going to talk about the order of money and understanding tax diversification. So that will be our first segment of the show this week. And then on our third segment, we're going to get into some questions and answers. Questions from individuals who listen to the show. And if you do have questions that you want us to read on air and answer, you can give us a call anytime at 810-355-2584. Or you can email us at askchris@thechrisberryshow.com. And we'll get to those questions and answers in our third segment. So I want to talk about the order of money. And this is important, especially given the current tax structure that we're in right now with the latest tax code updates. So the order of money. So I want to break it into four different categories when you think about money. And the first category is free money. So free money, that's money that's given to you for free. And so what am I talking about when I'm talking about free money? Well, what I'm talking about is money that you receive as part of an employer match. So if you're currently working right now and your employer offers any type of match in terms of your savings, we consider that free money. And free money is always going to be something that you want to take advantage of. So let's say that your employer offers a 401k plan. And as part of that, they will match up to a certain percentage. Well, that match is what we would call free money. And that's something that if you're not taking advantage of that's kind of silly, because you always want free money. That's the best kind of money. And if you are working for an employer and they do offer a match, now typically they would offer a match in your 401k, but also they might offer a Roth option. So the difference between a 401k and a Roth 401k is that the money you put into a 401k, that money is tax-deferred, meaning you put that money in pre-tax, but then when you pull it out, that money will be taxed. And especially if you think taxes are going up in the future, you might want to explore whether your employer offers a Roth 401k option. And I saw a recent statistic, and now about 70% of employers offer a Roth 401k option. So it's relatively a new offering from employers, but I would explore that because the money you put into a Roth 401k, that money is, when you put it in, it's post-tax, meaning you've already paid the income tax on it. But now what you can do is you can take advantage of tax-free growth. So the money you put into it, it's taxed once but then the money that grows inside of that money is going to come out tax-free. So especially as you get to 70 and a half, when you have to start taking out required minimum distributions and that type of thing, the idea of having some money that comes out tax-free, a tax-free leg of income in retirement can be very appealing, especially if you think taxes are going to go up in the future. So you have two options with that employee match. You can invest in a traditional 401k where that money is pre-tax, meaning you don't pay the income tax right away, but when you pull that money out, that money comes out tax-free. And then the second option is you could see if your employer offers a Roth 401k option where the money that you invest, it's post-tax, meaning you've already paid the income tax, but now you can take advantage of the tax-free growth. So that's the first type of money, is free money. And again, explore whether your company offers a Roth 401k option if you're currently working. Now, the second type of money after free money is tax-free money. And so this is money that you can take out tax-free or that you experience growth that is tax-free. Now, to do this, it's typically post-tax money that you invest in something like a Roth 401k or a Roth IRA. So that's money that you invest it. It's post-tax money, so it's money that you've already paid income tax on, but now you can experience tax-free growth. And there's other examples of this. For example, a 529, which is a type of investment for college education. So you invest post-tax money into this 529, and the growth inside of that 529 is tax-free. Likewise, a HSA is another example, a health savings account, where you can invest that money tax-free, but now the money has to be used for basically health costs, for example, doctor bills, that type of thing. In a 529, that's money that has to be used for education, whether it's college education or it could be private school. So K through 12 private school, now you could use that 529 money for that. That's a recent update to the rules. So the money that you invest in these is tax-free growth. Another example of tax-free investment would be something like an indexed universal life insurance policy or a life insurance policy that has cash value. Now, you might not traditionally think of life insurance as an investment, but there are certain types of life insurance that can double as an investment vehicle. And the reason why it's important to talk about this is because this is one of the ways that we can additionally create another form of tax-free income in the future. And a lot of times we're using what's called an index universal life insurance policy. Now, the life insurance piece, that's important, but it's not the most important piece of that index universal life insurance policy. The money we invest can be tied to an index. So if the market goes up, you participate in the upside of the market. And if the market goes down, you have downside protection. So that part is appealing. But then also all of that growth you get inside of that index universal life insurance policy, all that money that you invest, that money you can pull out tax-free, whether you want to use that money for college education or even another form of retirement income. And then the life insurance piece, well, when you're younger, you might be interested in the life insurance side of things, but as you get older, you might be less interested in the life insurance. Well, that life insurance can also double as a long-term care benefit as well. So as we get into our 70s and 80s, we're less concerned or have less of a need for the life insurance component, but that life insurance component can double as a long-term care benefit. So instead of having a death benefit, that death benefit could double as a long-term care benefit. So we have tax-free growth inside of the index universal life insurance policy. We have a death benefit if we're interested in that, but also it doubles as a long-term care benefit. So that's just another form of tax-free income that we can create, or another form of money, and that's that tax-free money. So we're talking about the order of money, and so far we've talked about free money, which is great, and that's the employer match. And then the second type of money we have is tax-free money. And tax-free money would be things like Roth IRAs, Roth 401ks, 529s, HSAs, health savings accounts, and index universal life insurance or cash value life insurance. Now we're going to talk about taxable money. So that's the third type of money, taxable money. So taxable money would be things like checking account, savings account, money market, brokerage accounts. So this is post-tax money, so money that you've already paid income tax on, and the growth on this is also taxable. So if you're getting things like dividends from these, you have to pay tax on it. So that's taxable money. And that's the third type of money, is taxable money. So checking accounts, which really don't offer much growth, but theoretically there could be some growth there, or savings accounts, CDs, those are all forms of taxable money. So in terms of the order of money, we have free money, which is employee match. We have tax-free money, which is things like Roth IRAs, Roth 401ks, 529s, HSAs, cash value life insurance. That's all tax-free money. And then we have taxable money. And taxable money is going to be things like CDs, brokerage accounts, savings accounts, money market, etc. And then that brings us to the fourth type of money. And the fourth type of money is tax-deferred money. So this is money that you don't pay tax on right away, but when you pull the money out of the investment, that's when you pay the tax. So you defer when you pay the tax. So forms of tax-deferred money would be 401ks at your employer, 403bs, 457s. So depending on what type of employer, whether it's a private company or if it's a nonprofit or a hospital or a public institution or a governmental employee, you're going to have basically the same type of thing, whether it's TSPs or 401ks. It's money that you put in tax-free initially, so you don't pay any income tax on it. But then as you pull the money out, that's when you have to pay the tax. So we call that, and we lump it all together, we call that tax-deferred money. So in terms of the order of money, we have free money, so money that you get for free, and that's the best kind, and that's going to be things like your employee match. Second would be tax-free money. Third, we have taxable money. And then fourth, we have tax-deferred money. Now, why it's important to understand these different kind of buckets or different types of money is because of diversification. So typically when we talk about diversification, we're going to talk about not having all your eggs in one basket. So if you have investable assets, maybe it doesn't make sense to have all your money in one stock, because if something happens at that company, now you could lose potentially all your money. So let's say you have invested all in Enron. Well, what is that worth right now? Nothing, right? And especially as you get in your retirement, you don't want all of your eggs in one basket. Well, likewise, in addition to just diversification among asset types, you should look at diversification amongst taxable accounts or types of money. So we call this tax diversification. So a lot of times people end up getting near retirement age or getting near age 70 and a half when you have to start paying income tax on those tax deferred accounts, and they have all of their money in these tax deferred accounts. And what we call that is the retirement savings tax time bomb, because once you turn 70 and a half, you have to start paying income tax on those tax deferred accounts. Those are what we call required minimum distributions. And at age 70 and a half, you have to pay 3.65% on those assets. And as you get older, each year you have to take out more and more required minimum distribution because it's based on a actuarial table, so that by age 115, you've paid all the income tax on those tax-deferred accounts. So the concept being is to think about, as you near retirement, trying to be as tax diversified as possible because especially if you think taxes are going to go up, which they are scheduled to in 2025. For example, right now, if you're in the 12% tax bracket, by 2025, that's now going to be the 15% tax bracket. So looking at tax diversification. So with that order of money, we need to understand how these different kind of buckets of money are taxed. So what is the maximum tax that you would pay for tax-deferred money? So as you pull this money out, what is the maximum tax possible right now? Well, right now it's 37%, meaning if you're in the top tax bracket and you're pulling out this tax-deferred money, you're paying a 37% tax potentially on those assets. Well, what is the maximum tax in those taxable accounts compared to tax-deferred? So tax-deferred is 37%. Taxable accounts, that's going to be looking at long-term capital gains, and that's a maximum tax of 20%. So in your tax-deferred bucket, that could be 37%. In your taxable bucket, that could be up to 20%. Now, what about the tax-free money? So pulling money out of tax-free accounts, what is the tax you pay on that? Well, 0%. So it's important to understand kind of the order of money, how this different types of asset classes are invested, whether it's tax-free money, employee match, tax-deferred, or taxable, so that as you're looking at pulling money out, so you're not in the accumulation stage, you're in the distribution, how is this money going to be taxed? And so understanding the order of money, looking at employee match, tax-free money, taxable money, and tax-deferred, it's important to understand that. So stick with us as we talk about these different types of money, how it works in terms of estate planning and having trusts. And join us in our next segment. Thank you.
The cost of care for an elderly loved one or a loved one with a chronic illness is shockingly expensive. If you are dealing with the unbelievable cost of care, make sure you get all the benefits you're entitled to. Here's certified elder law attorney Chris Berry from the Elder Care Firm in Brighton.
Most of my clients are really concerned about long-term care costs. They don't know where to turn, and what we can do is put together legal strategies to protect your resources and also bring in additional resources to help pay that cost of care. One of the things that they often say is that I wish I knew about this years prior. And unfortunately, the information's out there, but there's just so few certified elder law attorneys. As the only certified elder law attorney in Livingston County, it's my job to make sure that our seniors, our loved ones, our veterans have the best quality of care possible and the best quality of life possible.
Protect your hard-earned assets from probate, long-term care costs, and the IRS. The Elder Care Firm will get you the governmental benefits you deserve, including veterans benefits and Medicaid. Visit theeldercarefirm.com and schedule a free 15-minute phone consultation. That's theeldercarefirm.com.
Welcome back. So we were talking about the order of money and different types of money. And there was money that was free money. So that would be like an employer match. There's tax-free money, like 529s and Roth 401ks and Roth IRAs and Index Universal Life Insurance. And then there was taxable money, like CDs, savings accounts, brokerage accounts. And then there was tax-deferred money, like IRAs and 401ks, etc. And we talked about how tax-deferred money could be taxed up to 37%. Taxable money could be taxed up to 20%. Tax-free money, well, that's already taxed, so when you pull that money out, that money comes out tax-free. Now, let's tie these different types of money to some estate planning issues and some asset protection issues. So a lot of times when we're setting up an estate plan, think of that as your rule book versus relying on the government's rule book. So when you're creating your own rule book, a lot of times you're going to use a tool called a trust. And there's different types of trusts. And in fact, I just finished up this past week a continued education program for attorneys and financial advisors and CPAs in Lansing, where an organization called NBI, National Business Institute, reached out to me to give continued education to these CPAs and attorneys and financial advisors. And what my talk specifically was on was the taxation of asset protection trusts, as well as legal ethics. So we're going to talk about kind of trusts as a tool for not only estate planning but also asset protection. And then we're going to talk about how these different types of money, whether it's tax-deferred money, tax-free money, taxable money, kind of plays into a role with trusts. So with a trust, think of it kind of like a suitcase. While you're alive and well, you're holding on to the suitcase. God forbid something happens to you, you pass that suitcase on to your successor trustee, who then distributes the assets for the benefit of the beneficiaries. Now, what happens is that the trust only controls assets that are inside the trust. So think of it as a suitcase. If there's nothing in the suitcase, then you're just passing an empty suitcase. So it's important that we make sure that these different assets go into the trust somehow. And this is one of the big issues we see in our office is someone will have a trust, but they haven't funded it properly, meaning they don't have assets titled in the name of the trust. And there's two ways that assets could be titled in the name of the trust. One could be the trust is the owner. So if the account or asset says Jim and Lori Smith, trustees of the Smith Trust, then the trust is the owner of that account. If instead the trust is named as a beneficiary, then ownership would say Jim and Mary Smith as the owners, and then the beneficiary would be listed the Smith Trust. So it's important to understand that distinction of ownership versus naming the trust as a beneficiary. And where it really becomes important is when we're talking about setting up an asset protection trust. So really there's kind of two types of trust that we typically use in our office. One would be what's called a revocable living trust. And so this would be a trust that's set up to avoid probate and could control the distribution upon death. It's a very common type of trust. A lot of firms can set up a revocable living trust for you. But again, it's a great way to avoid probate and control that distribution upon death. Now, that's not the only type of trust that we can use. Also, we could set up an asset protection trust, like a castle trust. And what a castle trust can do is it can avoid probate, it can control the distribution upon death, but now it can build in asset protection to protect against things like lawsuits and potentially long-term care costs, because the assets in the trust would not be countable for things like Medicaid, which can help pay for governmental benefits. So if you were to need, or help pay for long-term care costs. So if you were to need long-term care, the assets inside of the trust would be protected from that nursing home or Medicaid spend down. So how these different types of money plays a role in the trust is we need to think about how we title these assets. For example, would you have a checking account inside of a trust? Well, typically you would name the trust as a beneficiary of a checking account. If it's money going in, money going out, that's where you're paying your different expenses. So the trust would be listed as transfer on death or payable on death to that account. But then the big question becomes, what about things like IRAs and 401ks? So we call those qualified money. So there's a tax qualification to those, as well as there are to things like Roth 401ks or Roth IRAs. All of those are what's called qualified accounts. Now, the thing with qualified accounts is that you have to be the owner of these different types of qualified accounts. So you have to be the owner of your IRA. You cannot name a trust as an owner of an IRA. Likewise, similar with a Roth or a 401k. You have to be the owner of those accounts. Now, what you can do is you can name the trust as a beneficiary. And a lot of times we do this in our office is we'll name the trust the beneficiary of an IRA or 401k or Roth account. And the reason for this is by naming the trust as the beneficiary, the trust can then control the distribution. And a lot of times when we're setting up a trust, we're setting it up not so that it goes outright to the kids at age 25, 30, 35, because all you're doing is launching a pillowcase of money at your beneficiaries. But instead, we can offer the option of a lifetime of asset protection for your beneficiaries if we name the trust as the beneficiary. And now a big concern that a lot of financial planners and tax people and even attorneys, they think if you name a trust as a beneficiary, then you have to pay all the income tax on those tax-deferred accounts all at once. But if you set up the trust properly, you can maintain that stretch out. And so what is the stretch out that I'm talking about? Well, as we discussed earlier, when you turn 70 and a half, you have to pull money from your tax-deferred accounts. You have to start taking what's called required minimum distributions, which at age 70 and a half is 3.65%. Well, when you pass away and it becomes an inherited IRA, whether it's in a trust or you naming the individual outright, they have to take required minimum distributions no matter what their age is. So at age 70 and a half, you might have to take out 3.65%. Well, if you were to inherit an IRA, so inherit one of these tax-deferred accounts, money that when you pull the money out, you have to pay the income tax, you don't have to pay all the income tax at once, but instead you can stretch out those required minimum distributions over your lifetime. So, for example, if at age 70 and a half, you have to take out 3.65%, well then, if you were to inherit an IRA at age 40, you might have to take out 2%, but you still have to pay the tax. Now, a lot of people think if you name a trust, you have to pay all that income tax at once. For example, if you were to inherit a $500,000 IRA inside of a trust, a lot of people, a lot of even financial planners, and a lot of attorneys, in fact, think that if you name a trust as a beneficiary of the IRA, that all of that tax has to be paid all up front or over 5 years because they think the trust doesn't qualify as what's called a designated beneficiary. But in fact, if you set up the trust properly, you can maintain that stretch out. So if you were to inherit a $500,000 IRA, you wouldn't have to pay all the income tax at once, jumping up your tax bracket, but instead you could stretch it out over your lifetime. So a lot of times we will name the trust as a beneficiary of those IRAs to maintain that asset protection. And that's especially important since 2014 when there was a Supreme Court case called Clark versus Ramaker that said that if you inherit an IRA, that you don't really have any asset protection, that you could lose that IRA due to a divorce or a bankruptcy, etc. But by naming a trust as a beneficiary of that IRA, we can maintain asset protection of those tax-deferred accounts. So a lot of times with that tax-deferred money, such as the IRAs, 401ks, 403bs, we'll name the trust as a beneficiary. And now, if you were to have a 401k, one of the things that we typically like to do is when you kind of retire or change jobs, a lot of times we do like to roll that 401k into an IRA because you have more choices with the IRA. Some 401ks will not allow you to name a trust or to engage in that stretch out. So it won't allow you to kind of defer paying those taxes. With the IRA, you're going to a lot of times have a lot more freedom. So a lot of times we would roll that 401k into an IRA. And you're not paying any of the tax. You're just taking it away from the plan administrator and now investing it basically wherever you want, whether it's TD Ameritrade, Fidelity, Vanguard, etc. But you would have more freedom. So with those tax-deferred accounts, a lot of times we name the trust as the beneficiary because we cannot name the trust as the owner of any qualified accounts. So that's going to be those tax-deferred accounts, 401ks, 403bs, IRAs, 457s, SEP IRAs. All of those are qualified accounts. And then what else are qualified accounts? Well, things like Roths. Roth IRAs, Roth 401ks, those are also qualified accounts. So a common question as individuals get near retirement, they look at diffusing that tax time bomb. So they want to get out of these tax-deferred accounts. And they always ask about things like Roth conversions, where you move money from the IRA, you pay the income tax, and now you invest it in a Roth. But how does this work when it comes to estate planning and more specifically setting up things like asset protection trusts to protect against nursing home costs, protect against lawsuits? Because a lot of times we've done a great job of accumulating all this wealth, and then now we want to look at protecting it and preserving it so that we can protect against things like unnecessary taxes, et cetera. And this is something that we really focus on in our workshops. So if you haven't been to one of our free workshops, we offer a workshop about once a week where we talk about wealth, estate, and tax planning for, we call it the second half of life. So from the time that you retire, how can we make sure that your money lasts as long as you do? And we do these workshops about once a week, and we have some workshops coming up in Brighton, Ann Arbor, and Livonia in the next couple of weeks. So Tuesday, April 2nd at 10 a.m. at our Brighton office, we're going to have a workshop. Then we're also going to have a workshop in Livonia on Thursday, April 4th at 2 p.m. And then in Ann Arbor on Thursday, April 11th at 2 o'clock. So if you want some more information on our workshops, please give us a call at 810-355-2584 or shoot us an email at askchris@thechrisberryshow.com, or you can go to our website, thechrisberryshow.com, and you can click through and register for one of our upcoming workshops where we talk about protecting your wealth so that your money lasts as long as you do. So we're talking about the order of money, understanding the different types of accounts, whether it's free money, tax-free money, taxable money, or tax-deferred money. And then talking about how do we tie that into our estate plan, tie that into the rule book that we create. And a lot of times we use a trust as part of our estate planning. And if it's a revocable trust, it's going to avoid probate and control the distribution upon death. Or we can look at an asset protection trust, which can avoid probate, control the distribution upon death, but now build in asset protection. And we use a tool called a castle trust to do that. And now if we have qualified accounts like Roth 401ks, Roth IRAs, traditional 401ks, traditional IRAs, then we have to name the trust as a beneficiary. But there's certain types of assets that we can invest directly in the trust, where now the trust can be the owner. And why that's important is if the trust is the owner, and I'm not talking about revocable trusts, I'm talking about asset protection trusts like the Castle Trust. If the trust is the owner, then that asset could be protected from a potential divorce if we set it up prior to marriage. Could be protected from lawsuits, could be protected from that nursing home or Medicaid spend down, so that we could have governmental benefits pay for that cost of care, but then a pot of resources available to pay for additional services to improve our quality of life, to make sure that we have the best quality of life possible. So things that we can invest inside of that asset protection trust, where the trust can be the owner, are things like taxable investments, so brokerage accounts, CDs, annuities, checking savings, all of that can be in the trust, as well as things like index universal life insurance. So if we're looking at a form of tax-free growth inside of the trust, we can't put a Roth inside of there because it's a qualified account. What we can put is cash value life insurance, so index universal life insurance. So that's a way that we could protect from that nursing home Medicaid spend down, but still experience the tax-free growth that a lot of individuals want. So there's different investments we can put inside of those trusts, but that's a way that we can protect those assets. So join me in our next segment as we continue this conversation and get into your questions and answers.
If you or a loved one is facing long-term care costs, make sure you talk with certified elder law attorney Chris Berry from the Elder Care Firm, like Jennifer did from Howell.
This past summer, my mom had to transition into a nursing home. So we contacted Chris to help get things in order. You know, I wanted the best. I wanted somebody who knew what they were doing. Chris was able to help save a lot of that money that my mom and dad both worked so hard for. I thought that everything would have to go to the nursing home, but it didn't. he was able to save us half of everything that would have gone if we hadn't contacted the elder care firm. And we're all happy about that. Don't go to the nursing home without contacting Chris first.
Hello, I'm attorney Chris Berry. The elder care firm is here to help you and your family find solutions. Call us today.
Protect your assets from probate, long-term care costs, the IRS, and get the governmental benefits you deserve. Visit theeldercarefirm.com today or call 810-214-3800. 810-214-3800.
Welcome back. So today we talked about the order of money, so understanding the different taxable, different types of buckets of money and how they're taxed. So you have free money, which is things like your employer match, tax-free money, so that's like your Roth 401ks, your Roth IRAs, your 529s, which are for college, your HSAs, which are health savings accounts, so used for healthcare expenses, and cash value life insurance like index universal life insurance. So all of that money is tax-free. Then we have taxable money, so that's like brokerage accounts, CDs, checking, savings. That's money that you already paid tax on, but now when you use that money or sell it or pull the money out, that money is taxable. And then we have tax-deferred money. So that's like IRAs, 401ks, tax-deferred money. So like IRAs, 401ks, etc. 403bs, things like that. That's money that when you invest in it, you don't pay any income tax, so it's pre-tax. But when you pull that money out, that's when you have to pay tax. And understand the different these different buckets are taxed differently. For example, your tax-deferred money, when you pull that money out, depending on your income, could be taxed at up to 37%. And then we have our taxable income. And taxable income is going to be taxed typically on capital gains, which max out at about 20%. And then we have tax-free money that when you pull that money out, that money comes out tax-free. So it's important to understand, especially if you think taxes are going up in the future, which they're scheduled to in 2025, to understand this tax diversification, where we don't want all of our money in just one of these buckets, but we want to diversify our sources of income between tax-deferred, taxable, and tax-free. And then when you combine this with estate planning, we need to understand how these different assets work, whether they're what's called a qualified account. So that would be anything that has a tax qualification to it, like a 401k, a Roth account. All of those are qualified accounts versus non-qualified investments, which could be things like checking, savings, real estate, cash value, life insurance. All of those things are what we call non-qualified assets. And whenever we're sitting down with a client to help them get organized for their planning, we typically break their investments into what we call non-qualified versus qualified, because the way that we plan for those different types of assets has a different approach with regards to how we're titling assets in the trust. So a lot of times when we're sitting down with a client to put together a comprehensive estate plan, a comprehensive plan, part of that will be setting up an estate plan and setting up a trust. And it's important to understand how these different assets get titled to the trust, whether we have ownership being the trust or if the trust is the beneficiary. So we would name the trust the beneficiary of those qualified accounts, like the 401ks, the IRAs, the Roths. But especially if we're setting up an asset protection trust that can protect against long-term care costs, can protect against lawsuits, we want to have as much of the assets titled or owned by the trust, not just having the trust as a beneficiary, but the trust is a true owner of that asset, because that's what's going to build in the asset protection. So that's where the qualified accounts, you have to be the owner. You have to be the owner of your 401k, of your IRA. When it becomes an inherited IRA, it works a little bit different, but you have to be the owner of those accounts. So let's say you're getting near retirement and you want to try to do some tax diversification. You might pull the money out of your 401k or IRA, pay the tax now because taxes are going up in the future. But then the question is, what do you do with that? Well, you could do a Roth conversion, so now you get tax-free growth, but the trust cannot be the owner of that Roth. So if you're looking at building in asset protection, if you want to protect your assets, you have to look at something other than a qualified account. And so that's where we'd look at checking accounts, savings accounts, brokerage accounts, money market, real estate. The trust can be owner of all this, annuities. The trust can be the owner. And then if you're looking at tax-free growth inside of the trust, what options do we have? Well, this is where a lot of times we look at cash value life insurance. So moving money in an intelligent manner out of those tax-deferred accounts, paying the tax sooner rather than later, investing it in the trust, and then now it's protected. And then the question is, how do we invest it in the trust? Well, we could have it in brokerage accounts. We could have that money in the market. That would be a taxable account where now we have to look at capital gains, which is better than it being in tax deferred because capital gains max out at 20% versus tax deferred maxes out at 37%. Or we could look at tax-free options. So what would be a tax-free option where we can invest it inside of the trust where it's protected? Well, that's where we could look at cash value life insurance, so index universal life insurance, where the money we invest in that gets tax-free growth. So it could be tied to an index. So if the market goes up, you participate in the upside of the market. If the market goes down, you don't lose anything. So you're protecting against volatility, but also you're protecting against taxes in the future because the growth inside of that is tax-free. So when you pull the money out, whether you're taking the cash value out of it or if you're taking loans on the policy, that money is tax-free. So we've created another form of tax-free income. And then on top of that, it's invested in the trust. So now we've protected against potential lawsuits and also long-term care costs as well, where the growth we have inside of the trust would be protected from that nursing home or Medicaid spend down. So it's important to understand just how these different types of assets interact when it relates to estate planning, when it relates to creating a trust. And it's a complex issue, but it's something that we cover in more detail in our workshops, and it's something that when we're sitting down with clients, we ensure they understand how these different assets interact with estate planning. And that's why it's important to have a comprehensive plan. Because you can't look at estate planning without also looking at taxes and financial planning. All of it has to work together. Too often we see clients where their tax plan doesn't match up with their estate plan and doesn't match up with a financial plan. For example, I've seen situations where the asset protection trust has been set up and we're planning for someone in their 80s, but they're invested entirely in growth and have a lot of volatility in the market. I had one client call me and say, Mom's portfolio where we've put it inside of an asset protection trust has went down over 17% in the last couple of months. And so we talk about protection, but there wasn't any protection against market volatility. So it's important. All these pieces really need to fit together for a comprehensive estate plan or a comprehensive plan for the second half of life. And so that's where a lot of times the best step or the next step is to think about attending one of our workshops. And we do these workshops at least once a week at one of our different locations. And we have some workshops coming up in Brighton, Ann Arbor, and Livonia in this next month. And if you want some more information on that, give us a call at 810-355-2584 or shoot us an email at askchris@thechrisberryshow.com. Or just go to our website, thechrisberryshow.com, and you can click through and register online for one of our upcoming workshops. And usually we have anywhere from 10 to 20 people at these workshops. Space is limited, so you do have to RSVP. But a lot of times, once someone attends these workshops, they want to share it with their friends and family because it's a different approach. So even if you have a financial plan or estate plan, or have someone do your taxes, it might be just worthwhile and educational to attend one of these workshops. And it's a chance where we can answer your questions. So we do provide some question and answer at these workshops. So if you do want some more information on that, again, give us a call, 810-355-2584, or shoot us an email at askchris@thechrisberryshow.com. And these workshops, we're talking about wealth, estate, and tax planning for the second half of life and how to protect yourself in 3 easy steps. So the stuff is complicated, and what we try to do is make it as simple and easy to understand as possible. So we're not trying to hit you over the head with complicated legalese or anything like that. We're trying to take these complicated financial, legal, and tax strategies, make them as easy to understand as possible. And again, if you already have a estate plan or you're working with a financial planner already, it might be good to just see what else is out there, get a second opinion on those. And that's where this workshop it's completely educational. So now, what I want to do is get into some of the questions and answers. So if you're not ready to attend a workshop, but you want a question answered, you can always send that in via email or phone or on our website. But the first question is from Bob. And Bob asks, my attorney is not a CELA, certified elder law attorney. What is the difference and why does that matter when I'm helping my parents plan for the estate? So it sounds like Bob's been a listener of the show and has heard us use the term certified elder law attorney or CELA. And what a certified elder law attorney is an attorney or an expert who's went through some additional education, but what they've really done is they've proven their expertise. So any attorney can say that they're an expert in a certain area. They can have a fancy website or say they focus on a certain or particular area. But what a CELA is, certified elder law attorney, is an attorney that has proven that they really know what they're talking about. And to become a certified elder law attorney, it's not an easy process. And less than 1% of all attorneys in Michigan or across the United States are certified elder law attorneys. It's a designation that's been around since the 90s. So to become a CELA, you have to be peer-reviewed, meaning other attorneys need to basically single you out for your contributions to this area of planning for the second half of life. And so there's a lot of estate planning attorneys out there, and estate planning is really just planning for what happens when you die, versus elder law and planning for the second half of life. It's planning for what happens if you don't die, making sure that your money lasts as long as you do. So to become a CELA, you have to be peer-reviewed, meaning other attorneys, other professionals need to have singled you out for your contributions to this area. And then from there, you have the opportunity to sit down and take an exam. And as an attorney, once you take a bar exam, you never want to take another exam ever again in your life. And this is a 6-hour exam that actually tests on 12 different areas of elder care or planning for the second half of life. For example, it tests on Social Security and estate planning and just making sure that individuals' money lasts as long as they do. And I think the last statistic I heard is that only 13% of the attorneys that took the exam passed it, and it's offered twice a year. Now I think there might be 20 of us in the state of Michigan, maybe 500 across the whole nation. And this is a designation that's been around since the 90s. And I liken it to martial arts. So I do this martial art called Brazilian Jiu-Jitsu. And what it is basically you're rolling around, kind of wrestling and trying to choke people out or break an arm via arm bars. But there's no striking in it. So it's a way that you can kind of wrestle and do a martial art without hitting anyone, without really hurting anyone. And there's different belts based on your level of knowledge. So there's like white belt and blue belt and purple belt and brown belt and black belt. So I've been doing this jiu-jitsu for about 4 or 5 years now, and right now I'm a blue belt. So I'm kind of starting my journey. I know enough, but I know enough to be dangerous, right? Well, the CELA is thought of as black belts when it comes to planning for the second half of life. So if you sat down with an advisor or attorney and they're not a CELA, they might be a blue belt or a purple belt as it relates to this type of planning versus really being a black belt. And so the problem with that is sometimes they know enough to be dangerous, but they're not asking the right questions or they don't understand all the options that are available. So, for example, I sat down with one family And they attended one of our workshops, and they heard about it from a friend. They just did a plan. They just sat down with an attorney and advisor, and they attended the workshop. And one of the things they asked was, why didn't my attorney talk about the things that you're talking about in the workshop? And I had to tell them that, unfortunately, not everyone has the same level of knowledge. Just like not everyone that's doing a martial art are black belts. Some people are just starting their journey. Some people, they've been doing the journey for a number of years, but they've kind of maxed out, or they just don't want to learn anymore. And so I think one of the reasons why that we've just developed this deep level of knowledge is something probably that my parents just beat into me, is this constant need to continue learning. So even though I've been doing this for 15 years, I'm always attending different events. I'm trying to learn from different people. It seems like about a month out of the year, I'm attending different national conferences, whether I'm speaking or whether I'm asked to speak or whether I'm just attending, trying to learn from other practitioners. So with this deep level of knowledge, we've continued to kind of hone our practice to keep learning, to not stop at a blue belt or purple belt, but really develop that black belt level of knowledge as it relates to planning for the second half of life. So that's why sometimes some of the issues we talk about on the show, some of the things that we cover in the workshop, a lot of times for some individuals, it's their first time hearing it. And it's not because these are new strategies. It's just that we've developed this deep level of knowledge in a very specific area of planning for the second half of life. So some of the strategies we talk about in our workshops, some of the strategies we talk about on this radio show, it's not necessarily mainstream. And I scratch my head of why other people aren't talking about these things like tax diversification or setting up asset protection trusts. I think more and more we'll be talking about it just because longevity and protection really seems to be more important to individuals these days, because we're not going from healthy to just passing away. And that's what estate planning is really about. But what we're doing is we're going through this the second half of life where we're living longer than ever, and we need to make sure that our money lasts as long as possible. So hopefully that was helpful, Bob. Kind of gave you a long-winded answer, but it's something that I'm passionate about. It's just constantly learning, trying to offer the best solutions for our clients. And so a lot of times a workshop is a great way to do that, and hopefully I see you at one of our upcoming workshops. And with that, I just want to thank everyone for listening. I want you to make sure you have a great week, and I'll talk to you next week. Take care. Bye-bye.
Learn more about Chris Berry and the Elder Care Firm by visiting online at MichiganEstatePlanning.com. That's MichiganEstatePlanning.com. You can also call Chris Berry at 888-390-4360. 888-390-4360. This program content reflects the opinions of Chris Berry and his guests, not the Elder Care Firm, Prosperity Capital Advisors, or the C.J. Berry Group, and is subject to change at any time without notice. Content provided herein is for informational purposes only and should not be used or construed as investment or legal advice or a recommendation regarding the purchase or sale of any security or to follow any legal or tax strategy. There's no guarantee that the strategist's statements, opinions, or forecast provided herein will prove to be correct. Past performance is not a guarantee of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses, which would reduce returns. All investing involves risk, including the potential for loss of principal. There's no guarantee that any investment plan or strategy will be successful. We recommend that you consult with a professional dedicated to your needs. This program is furnished by the Elder Care Firm.